for me, the movement of a price chart, for me, that pattern is just complete randomness.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome back to the Two Traders Podcast. Walter here. I've got Darren on the line. How are you today, Darren?
Hello, Walter. Very good, thanks, mate.
Well, I want to talk about the gambler's fallacy, and I'll just introduce it for those of you who haven't heard of this idea. So my friend and I in university, we had a lot of statistics courses, mostly because they told us that if we were to take a lot of statistics courses, we'd be likely to get into graduate school. So they said, you really need to take statistics courses. So we took a lot of these courses, and one of my professors, who was a fascinating guy, we had this idea, and the idea was that where I went to school, Darren, wasn't too far from Las Vegas. It was maybe, I don't know, like a 4-hour drive from Las Vegas, 5-hour drive from Las Vegas. And so we had this idea that we were going to go to Las Vegas and play blackjack, and we were going to make all this money. And the idea my friend had was that after every bet, if he lost, he would, of course, double the bet. So if he lost $10, the next game he'd play for 20. If he lost that, the next game he'd play for 40, and so forth. He'd keep going up. And he had these deck of cards that he carried around, and he kept playing the game, and he wanted to see how many losers he could have in a row because he wanted to be able to survive a losing streak. And so he presented this idea to our statistics professor and said, look, why wouldn't you just do this if you went to Las Vegas? Because you're sure to make money, because eventually you're going to have a win and you're going to get all that money back plus a little bit more. And he looked at us and he said, are you serious? That's the gambler's fallacy, which is basically this idea that if something happens more frequently than normal, it'll happen less frequently in the future. So it's this idea that, same thing with roulette. So if you're looking at the roulette wheel and you see that red has come up 12 times in a row, you would go down and put money on black because it's certain to come up again, right? It's due to come up again. So that's the idea, is that these sorts of things are related and that they're not independent events. So my question is, how does that relate to your trading, and what are your thoughts about this idea of independent trading results versus related trading results?
Yeah, well, I'm very 50-50 down the line. It's all random, and whatever happened before bears no relevance on what's happening next. And kind of the same with my ideas on technical analysis, really. You're damned if you do and you're damned if you don't, really. So, yeah, I mean, I suppose people, I mean, is it kind of the same as that notion where, this trend's been going on for way too long, so it's got to reverse now? You know, because it has to. There's a greater chance that it's going to reverse, whereas actually it's just as likely to continue falling as it is to reverse. But does the sort of human behaviour element come into it then and affect that? Because for me, the movement of a price chart, for me, that pattern is just complete randomness. But obviously what's making that occur is not randomness. So I'm kind of a bit muddled with it, really. I mean, is that what you mean, or am I way off the mark here? Yeah.
So it's just, it's just the idea, like, okay, so trader comes up to you and says, Darren, I've had 7 losers in a row, and my back testing has shown that it's highly unlikely to have 7 losers in a row, that it's a 0.5% chance of that given the parameters of my system. So what do you propose that I do for trade number 8? Because I'm thinking of increasing my risk for that trade, right? So what would you say?
Well, I would tell him that his trade is 50-50 no matter what's happened before, and it has no effect on the next trade you're in. Yeah, so you'd be very unwise to load up on this next trade with some sort of notion that your losing streak has got to end, because it's just not true.
Absolutely, and I think it's the same thing in terms of traders who say, I remember the first couple of traders that I was showing them what I was doing, and it was sort of like this mini course in my living room, and I said, well, tell me some money management or risk management strategies. And one of the ones they came up with was we would risk more money on those trades that we were sure to work out. I thought that was bizarre. I thought, are you serious? Like you're going to risk more money when you know it's a winner? So why even risk any money at all on the ones that you don't think are likely to be winners, right? I mean, what's the point? Yeah, it's kind of the same idea here. But I will say this, in fairness to those people who are thinking right now, listening to this saying, well, you guys have got it all wrong. There are some trading systems where each individual trade that you take is not independent and it is related to the previous trade. And that's true. Like there's a whole area of statistics called time series analysis where they're looking at different events as they occur in a series and they're related. And the rules of statistics totally change because in all of statistics you assume that every single event is independent, and if not, then you got to move it into this other box they call basically related events time series. So here's an example, Darren. Let's say I'm a trend follower, and let's say I've decided to go short the euro. I'm going to sell the euro, I'm going to buy US dollars because it's in a downtrend. Well, if this is the case, then every time I get a signal, the euro pulls back, comes up a little bit, and I get a signal to sell it again, I would sell, right? Fair enough. Well, what's going to happen at the end of that trend? When that trend's over and the market decides to start going up again instead of down, I'm going to start to lose money. But what that means is, because the market is starting to change, maybe my last trade was a loser because I thought the market was going to make a new low and it didn't. And then I took another trade because I got another signal and that was also a loser, right? And then I took another trade and that was also a loser. So I've taken 3 losing trades in a row. And they really are in some way related because the market is no longer in a downtrend now, right? What I'm saying is if you're a trend trader and you're taking trades in your bias is in one direction, then you would expect some correlation to be involved when you're looking at trades around that recent trade that you've taken. Does that make sense?
Yeah, I suppose so. I mean, are you saying that if you have a string of losses and you're a trend trader, then that's a pretty good indication that the trend is failing, basically, or weakening? Is that what you're saying?
Yeah. Well, that's that's kind of the reverse. Yeah, that's the other side of the coin, which is, so I would expect that at the end of every trend, I would have a lot of losers as a trend follower. And also I would expect that my losers would tend to clump together. So maybe something, if I've got this bias and I'm only taking buy trades or sell trades based on what I've determined as the trend, then I would expect that to happen. That in general, I'll have a lot of losers clumped together. I'll have some sprinkled in there, of course, during the midst of a strong trend, but mostly they'll clump together at the end. And so by definition, my trades aren't really independent because losers are likely to follow losers, right? Whereas in general, that's not to be the case. Now, I've just made this magical trend system up here, but I'm just talking it out loud to show why some traders who are listening to this are thinking, yeah, well, you're right. If, like Darren, if you're trading the pound today and tomorrow you're trading the euro CAD, right, and then the next day you're trading the Swiss yen, well, why would they be related? They're independent trades, they're independent markets. Even if you are using the same strategy, why would they be related? But if I'm trading the pound, straight for 2 months, then I would expect my losers to clump around those periods when the trend is starting to fizzle out.
Yeah, I suppose, they give you some information, certainly, but there's still no reason that trade 4 couldn't be a massive winner and the trend resume. So I don't think I'd want to, certainly it's great for expectation. It's certainly important for sort of, expecting what your particular strategy is going to give you in the way of strings of losses and winners. Last week I had my first 8 trades of the week were losers. And in a way, I suppose I continued trading because I knew that the possibilities of it continuing were slim. But not because I'd had those 8 losers, more because it's unusual for it to do that. At the same time, if it had gone on all week, I'd have been gutted. But I wouldn't think that it was anything that I could have avoided by looking at my other results.
Right. So you don't use past trade data to anticipate the future. In other words, you don't say, okay, well, I had 8 losers. Well, I guess in a way you were looking at going, well, this can't go on forever, right?
Yeah, because it's unusual for price to consolidate all week, and basically that's what creates my losers. If we go up a little bit and down a little bit and then end the day pretty much where we started, that pretty much nullifies any edge my strategy's got. But it's quite hard to find, weeks where that happens all week. Essentially you're talking about a very narrow range weekly bar. Have a look at your weekly chart. You do get 1 or 2 of them, but it's much more likely that there is going to be some movement at some point through the week on the current trades, currencies that I trade anyway. I suppose I kind of have that expectation that I kind of ballpark it rather than looking at specific data, and I kind of roughly know I'm going to get 1 or 2 days a week. Most likely 2 days a week where my strategy is horrible. But I'm certainly not going to go back through 12 years and work out the exact amount because I just think that is just a complete waste of time, because it's just trying to be too complex, really. And I think it's trying to, like I always say, I think it's trying to remove too much uncertainty with data, and I know that is comforting, but I think in the long run it's damaging and makes trading harder.
Right. But let me ask you this. What about to those who say, yep, fair enough, I understand that I shouldn't use these data in my future projections or, management or whatever of my trades, but I was able to get some experience trading the system. So I kind of, do you know what I mean? Like I saw it in different market conditions and I've executed it over and over again in Forex testers, so at least I'm comfortable with the system. What do you say to that?
Yeah, and I'm kind of cautious to sort of poo-poo anyone's road to learning to be a trader and saying it doesn't work, because I really want to try and avoid that, because I don't believe you can truly say that about any way of trading. I think it's important, but again, I think it's given too much importance, and not enough importance is given to the fact that data is really just a ballpark figure, and different market conditions can basically throw all of those figures way out of kilter, and even like minute differences where 2 years look like particularly like the similar sort of movement, just slight variations in the price action can change that data. And I think if you go into it too deeply, you start to alter your strategy and you kind of nullify the edge that it's really got. And quite often, people's edge in trading is just something simple like they use a bit of a wider stop initially and then move it up. Or it might be that they let trades run, so they're kind of either taking their risk off really quickly, getting stopped out a lot, so taking very small losses, and then when they do hit nice momentum and that, they get a big win, that's where their profit comes. Vice versa, like me, I take quite a lot of fairly large hits, but when price finally moves, I tend to have quite a few positions in, and I let them grow, and on average my winners are bigger than my losers. And I think it's subtle things like that make you profit, and not like the particular going into the figures of win rate and loss rate and the figures. I don't like figures in trading.
Right. So you would definitely, so you're definitely not a fundamental analysis trader either, like looking at figures and reports and things like that.
No.
Yeah, I agree. I don't think you can trust what the government numbers are anywhere. I think that some of the most savvy guys that are fundamental traders, they don't look at official government numbers. They look at other things, but that tell the story. But yeah, okay, so fair enough.
It's relative. It's relative as well, isn't it? I mean, I was on a forum the other day when I think it was the Bank of England data came out, and I can't remember what the data was, but so essentially they were expecting 2.2 or something, and it was 1.4 or whatever. And instantly the messages started coming down. The data was bad and price goes up. What's going on? Well, who says it's bad? It was worse than expected, but that might still be a good figure. So it's all relative, really. It's relative whether you think it's good or bad. Everyone's going to have their opinion on it. And there's just one figure. What about all the other figures that didn't come out today? And, all the figures for the currency that you're trading it against. That was just a really good example for me how numbers, particularly, can really throw people, and just instantly they're locked into a bias. Like numbers out for 2 minutes, bosh, they think that should be, make a certain reaction in the market, and it did the complete opposite.
Yeah, and it's like the gambler's fallacy. Just because you've had so many winners or losers doesn't mean that has much to do with what's going to happen next. I will say, though, it's tricky, though, as traders, because, for example, if you know, Darren, that your win rate's going to be around 50%, it's tricky to know that after 8 losers in a row, you are still trading that 50% win rate, because it feels like the market's changed. It feels like something's wrong. It feels like it doesn't work anymore. But you take a longer term point of view and just kind of ride it out. So I have to know. So how did the week end up for you? Was it down a little bit still, or was it a profitable week in the end?
No, I shut shop on Wednesday evening, 50% over my target for the week.
Right, that's excellent. Yeah, that's excellent.
Yeah, so Monday and Tuesday it didn't move, and then it broke out and went long all day Wednesday. And by the end of Wednesday, my 2 winning trades had, covered my 8 losses and gave me my target for the week. So yeah, and that's kind of what I expect to happen. Sometimes it breaks out and it just covers my losses, and you just kind of have to accept that. But yeah, it's difficult. If you think about the figures all the time, I think it becomes a bit of a burden for you, because you're comparing what's happening right now with what you're expecting to happen, and what you're expecting to happen is based on what happened in the past. And usually, people are using a lot of data, so they'll take like 5 years of data, and then, they've taken 8 trades, and they're kind of expecting those 8 trades to somehow kind of replicate the average of the, for me, it doesn't make sense. It's illogical. But I understand a lot of people go that way, and a lot of people make it work. Just like one last thing on the gambler's fallacy thing. I've read a lot of really successful traders in the past say, you've got to kind of go all in when it's good, and then sort of be cautious when it's not. Are they kind of falling into that trap as well, but just somehow they're kind of making it work for themselves? Like the guy who shorted the pound with the Bank of England or something and made millions.
Yeah, George Soros.
Yeah. Is that kind of is he kind of using that, but kind of making it work?
Yeah, from everything I've read, Soros is basically using and has taught to use that money management strategy that I was laughing about. When I first taught trading to a couple of traders, which was, he basically says it takes courage to be a pig, and you've got to go all in when you know you're right. So maybe he was shorting the pound. I think he was shorting the pound against the Deutschmark at the time, and I think maybe he was shorting it, and then finally, when he got something really good, he just went all in or something. Maybe he was like in The Big Short, when those guys were right about shorting the housing market and the mortgage market. They were right, but they still had to, they still had to ride out the storm, which was they were losing so much money, and they had to pay into these trades just to keep them open, even though they knew they were right. That's one of the things about being over leveraged and risking too much. You can be right and still go broke. So, I've really enjoyed this one, Darren. Thanks for your thoughts on the gambler's fallacy. What are we going to talk about next time? Any ideas? I've been thinking about a few things.
I'm short on ideas, because I find it very difficult to kind of fit into the trade. I'm constantly searching for someone who's kind of saying the same thing as me, and I can never find it, and that that should worry me. But I suppose really that might be a good thing, really.
Yeah, no, I think that's a great thing. Let's talk about this idea that I think is interesting, as it relates to trading, which is this idea of the observer effect. So maybe next time we can sit down and talk about the observer effect and how that might affect your trading. I think that would be an interesting one.
Cool. I'll get reading, Walter.
All right. All right. See you next time, Darren.
Okay. Cheerio.
Bye.